Okay, so hello everyone, and thank you for being here with us at this session with John Ho. I'm David Serre, founder and president of Blockchain at HEC, created in 2017 to share knowledge on Web3, blockchain and crypto economy, and connect ecosystems. So I will moderate this session with Ethan, also a member of the core team and president of the student club Blockchain at HEC. So first of all, I would like to thank our prime sponsors, Stake Capital Group, PwC, and other partners like HEC Alumni, HEC Paris, and all the 100 speakers and companies who have already come to shed some light on the world of Web3. So I remind you that we have 2 or 3 webinars a month and a big in-person event on the 2nd of March about metaverse and business. I'm not talking about the other ones in the year. So stay tuned by following our LinkedIn page, website, blockchain-hec.com, and our Discord. I strongly invite you to register for all these conferences, which are free and available to all. A link will circulate in the chat to register. So to come back to today's topic, we're giving the floor to John Ho, head of legal of one of the 50 biggest banks in the world, the Standard Chartered Bank. John Ho is a key expert in finance and digital assets. John, you introduce yourself, so maybe I leave you the floor right now for introducing yourself. Thank you very much for being here. It's a big honor.
Thank you. Thanks, David and Ethan and everyone on the call. I'm grateful and honored to be invited to share the topic of digital assets and tokenization. This is obviously a sort of a hot topic, and very happy to do that. I think before we start, just a couple of housekeeping. The views and presentations are my own. It doesn't necessarily reflect the views of the organization I represent. With that, let me start the presentation proper. Just want to make sure that you could see my screen on the presentation mode. Is it clear now? Just wanted to check.
Perfect. Yeah, we see very well. Excellent.
Okay. I think with that, just wanted to tell you, why are we here, right? Digital assets and tokenization. Where are we now? So just to set in perspective, despite the crypto winter digital assets we're facing now, in terms of the investment in the sort of the institutional infrastructure on blockchain, 133 billion on annualized costs of financial institution has spent on existing post-trade securities clearing system. This is the sort of survey done by Accenture and part of Capital Venture Vision 2022. The market capitalization of crypto assets, notwithstanding, have gone down from 3 trillion, is still largely about approximately 1 trillion today, as of the 17th of January 2023. And the potential tokenization market opportunity that Bitbon have indicated last month, part of the Bitcoin research, is $16 trillion by 2030. Wow. If you look at the sort of other market cap here, the blockchain sort of investment is still a huge amount in 2.4 billion. Now, just to understand the sort of types of digital assets, digital assets doesn't mean everything to everyone. I think in a nutshell, it can be subsumed into a couple of categories. Cryptocurrencies, these are tokens that are attributable value for purpose of exchanges. Things like Bitcoin, Ether are sort of the most well-known sort of cryptocurrencies. Then you have utility tokens out there, tokens that are offered by platforms that are used to support services and functions. For example, Ethereum as well, Stellar, EOS. Then you have stable coins, which are tokens providing a stable value in sort of the crypto world. You have security token as well, tokens that have the characteristic of securities, such as equity, debt, derivative, with income generating components. Last but not least, you have non-fungible tokens. These are tokens that are rare, scarce, with unique features that are non-fungible with other asset classes. Very quickly, in terms of stable coins, there are obviously 4 categories. You have fiat collateralized based. You have also commodity collateralized, crypto collateralized, and then the most infamous one is the algorithmic stable coins, where you see Terra Luna, and in May, when it imploded, it does not have an actual backing because it's based on an algorithmic sort of formula. Now, what is tokenization? In simple terms, tokenizations of assets involve the digital representation of real or digital native assets that are recorded or transacted on a distributed ledger technology or blockchain. Key features, obviously, you can actually tokenize any assets of value. It could be real life assets, financial instrument, collectibles, consumable, or digital native assets, what we have in NFTs, non-fungible tokens. Moving on to the next slide that we talk about is respect to other tokens that we have in mind. If you look at the current state of the bond issuance, it has many, many handoffs and many, many parties. The process to issue a bond right now is a long gestation period. But to date, a number of institutions have managed to sort of crack, or rather provide for what we call digital bond that can automate certain functions and provide for lowering of costs, automation of functions, and back office efficiencies, and also the ability to reduce intermediaries in the process, hence lowering operational costs and risks. So blockchain building blocks, you have tokenization, custody, blockchains for record keeping as well. Now, earlier we talked about is the simplified process for security token. We are in the world where tokenization exists not just on private blockchain, but also public permission blockchain, as we've seen in the use cases, especially if you look at today's press. Societe Generale, a well-known French bank, have issued obviously a tokenized securities in exchange for DAI on a DeFi platform. So that shows the sort of the use cases where traditional finance utilizes decentralized platform to create liquidity in an asset class that does not exist. So the benefits of tokenization obviously is efficiency gains, fractional ownership, increased liquidity, fractional ownership. And because blockchain is immutable, it's a record that you can see, it's provide a level of transparency as well. Obviously, last but not least, we can't just look at the benefits. There are things you need to address. For example, AML, anti-money laundering risks, technology, smart contract risks, cybersecurity, data protections, gaps in legal and regulatory framework. These are obviously building blocks, risks and challenges that need to be addressed in any deployment of infrastructure involving DLT, tokenization, in cryptographic. So where are we in the sort of tokenized market cap? Now, the Bitbond did a research last month. The total tokenized market cap is estimated to be 10% of global GDP by 2030. The wallet size is $16 trillion by 2030. That's 7 years away. It's not very long, but what it shows from a trajectory perspective, that the opportunities to tokenize illiquid assets of value is huge. And we are now only in the early innings. So what can we tokenize, right? Not only can we tokenize traditional assets, we also can tokenize on-chain assets, so, in the context of private markets, SME revenues, private debt, private funds, and in the digital global markets, you can also tokenize. We have seen use cases of tokenization of real estate, fixed income, commodities. So the types of tokenized assets is huge and immense. And we are only in the start of the early innings of a tokenization journey. So the choice of blockchain that people have been using so far is obviously looking at public and private, but in the context of what we're seeing in the public side, they're using Ethereum, Polygon, Layer 2, Avalanche, Stellar, and these are also not the only types of tokenization that have been used. But what I've listed here is obviously those that we've seen that increasingly are being used, but obviously there are many, many types of other protocol out there, whether it's Polkadots, Algorand, that are obviously increasingly being used for tokenization of digital representation of value. In terms of the token universe we look at, we have obviously stable coins, earlier I mentioned, non-fungible tokens. These are digital art, ticketing, gaming, carbon credit tokens that are also being used now to tokenize carbon credit that is being captured to be retired as part of decarbonization platforms. You have platform tokens, you have security tokens, and I earlier mentioned, you can also tokenize real estate, as we can see in some platforms such as stock or timeless. Now, token standards, what are the most common token standards being used? The ERC20 and ERC 1400 are the most commonly used token standards for tokenization of financial assets. And what are financial institutions doing about it? Where do we see value? So we see value in the trading of new digital assets. On the trading platform, providing custody, we also see the value of trading of tokenized assets. Assets that are illiquid, traditionally difficult to sell down, can now be parceled down to tokenization, creating fractional ownership, unlocking value, and enlarging a wider base of potential clients. So financial institutions traditionally are more now moving into the space in terms of providing custody, wallet that are investment, institutional grade, being involved in exchanges, being involved in trading, and also being involved in wealth products, advising clients in certain types of digital assets investment in the private sort of banking space. So what else that tokenization have been doing? So today's news, in the news, you have Societe Generale using a tokenization platform to bridge between CeFi, central finance, and DeFi. What they have done in this case, perhaps they issue tokenized securities on a blockchain that is used in exchange for DAI. So that creates sort of a market value where you have a traditional bank using a DeFi platform to create liquidity pool. So this shows the potential of sort of creation of value, and also the potential where CeFi and DeFi could bridge together using tokenization platform. The other sort of area that is hot right now is green bond tokenization. So the BIS, Bank for International Settlement, late last year, have announced the launch of what we call Project Genesis, which is its first green finance product in conjunction with the Hong Kong Monetary Authority that explore how do we issue green products through the combination of blockchain, smart contracts, Internet of Things, and digital assets. It explores how finance can transition to a green and sustainable future. Sustainability can be achieved by integrating blockchain and other technology into the process that bring financial products to market. It also allows for the reduction of greenwashing products to real-time traceability, tracking, and disclosure standards that can be harmonized. So what are they doing in the prototype? Optimize bond creation, tracking green products, streamlining coupon distribution through smart contract, and improving liquidity in the secondary market. So the Project Genesis have shown the benefits that can be harnessed through the blockchain technology if it is well designed. Moving on to the regulatory space, when we talk about tokenization, one should not forget that technically you can tokenize anything, but you got to do it in a regulated manner, especially where you involve consumers, it involves parties, it involves transactions that are regulated in certain activity in certain countries. In the EU, they have obviously introduced the market in crypto assets, MiCA. As we speak, the EU Parliament is supposed to vote on the final text of MiCA, estimated to be April this year. And what MiCA does is provide a comprehensive regulation in terms of regulating crypto assets that are not considered securities. Where the digital assets are securities, they'll be regulated by the securities law at the relevant regime in the EU. But MICA provides, if it's finalized and launched, estimated to be 2024, it will provide a pan-European-wide legislation for the issuance and regulation of sort of stable coins and also asset-backed tokens. If you look at tokenization framework, the world is moving towards a regulated sort of space. Tokenized issuance will be regulated in the EU, in the future in the UK, US is looking into this, UAE, Germany as well as quite a sort of a German law that actually provides for the tokenization of securities. So as Switzerland in Europe, and you have outside of EU, Singapore, Hong Kong, Japan, South Korea are providing a platform for the issuance of tokenization of financial assets. If you look at case studies here, ABN AMRO, just a couple of days ago, has become the first bank in Europe to register a digital bond for a mid-corp client on a public blockchain. This was released on the 15th of January, 2023, a couple of days ago. And then just yesterday, on 16th of January, the city of Lugano in Switzerland had placed the first native digital bond ever to be issued by a regulated financial market infrastructure, in this case by SIX Digital Exchange. You could see now, when we talk about tokenization, it's no longer a pipe dream, it's a reality. But it is still, as I mentioned, early building blocks. The first blockchain bond that was issued was done in 2018 by the World Bank, when they launched the world's first bond issuance, the size of 110 million Aussie dollars, where the bond could be fractionalized, could be allocated to institutional investors. The solution is designed to leverage emerging technologies such as blockchain to make capital markets more secure and efficient. You have obviously the first covered bond that was issued by Societe Generale in 2019 that sets the tone and manner in which the French banks are leading the way in Europe in terms of security token on a public blockchain. What they have done in terms of the hypothesis is it be able to show that in a well-calibrated design platform, tokenization can create efficiency, reduce costs, and also reduce the number of hand-offs and intermediary in a traditional bond process. JP Morgan in 2018 was the first US bank that created JP Morgan Coin based on its quorum technology, enabling instantaneous transfer of payment between institutional accounts within their ecosystem. And IBM 2018 issued a real-time global payment network for regulated institutions for provision of cross-border FX. Very close to that is what we call central bank digital currency. You have the Bank of BIS Innovation Hub, Swiss National Bank, and SIX testing using digital euro as settlement currency in respect of a digital bond. We have Project Guardian in Singapore, which is piloting tokenization in a DeFi ecosystem. And last but not least, the Singapore Exchange, SGX, has tied up with HSBC and Temasek to issue the first digital bond issuance on SGX digital platform. Now, let's not forget the other things that's happening in the central bank world is central bank digital currency. It is sort of the new paradigm shift in terms of digital payment. CBDC is a huge phenomenon that has gripped the attention of central banks around the world. 90% of central banks to date are either researching, piloting, or doing a soft launch on CBDC globally. In Europe, Digital Euro project scheme has now gone through the investigative phase. Just a couple of days ago, the ECB have launched a call for submission in terms of inviting vendors to test in an investigative phase. You could see the central banks are very focused on providing a digital alternative to physical cash in an increasingly digitalized world. So what does tokenization offer us? If you're all here on this audience, it does open a spectrum, a business model that currently doesn't exist. Whether you act as an issuer, it also potentially unlocks illiquid assets and creation of secondary market. There's a role now for what we call global custodian digital assets, new business model and fund administration, credit rating, investor right, cost reduction, and post-trade settlement efficiency. Now, if you look at this picture, you might recognize this individual called Larry Fink. Larry Fink is the CEO of the largest fund manager in the world, handling trillions of dollars. Just a couple of days ago, Larry Fink said, the future of global markets is a tokenization of financial assets. And he's not mincing his words. He's saying, in the future, tokenization of stocks, securities, and financial assets will be a huge paradigm shift to unlock value, creating new asset classes, and allowing for new sets of investors that are so savvy, are used to trading, executing on what we call an increasingly digitalized environment. So what are the future trends here? I think when we look at tokenization, it's not just about crypto. You got to look at the big picture. Tokenization, as I mentioned, it is a digital representation of value. It covers not just cryptos. In the earlier slides, it's NFTs. Increasingly, it looks at use cases like stable coins in decentralized platform. And we are in the world where payment rails will be increasingly digitalized. In addition to physical cash, we will then see in the next 5 years, major currencies, major economies issuing what we call central bank digital currency. And in the case of Europe, the ECB has set a time frame later this year when they finalize the investigative phase to then decide whether formally to issue a CBDC by 2026. So, ladies and gentlemen, digital assets is here to stay. The question now to all of us, how do I play a role? And how do I make myself relevant in this increasingly digitalized space? And with that, I end my presentation and happy to take any question.
John, amazing presentation. Thank you very much. Really, really nice. We'll start off with maybe let me bring you just a short recap also of what you've done also, because you kind of a rock star in the field, clearly we can say it. So you're a mentor at R3 Venture Development Program. You're a mentor also at LongHash Ventures. For those who do not know LongHash Ventures, it's a global incubator network which provides a full range of support for startups working on blockchain-related projects, empowering founders to build Web3. So like projects like, as you said, Polkadot, Zapper, Balancer, DODO, Acala, Instadapp, etc. So one of the first questions I had is about the risks, and actually there's a link also with the question of Eric in the chat. So how can companies and individuals best navigate the risks associated with investing in digital assets?
Yeah, I think what is important when we look at digital assets is not just more often than not, when we look at startups, they highlight on the usual things that my blockchain has a very high throughput. It is the fastest. You can do a lot of things. You can tokenize a lot of things. I think we're in a world where if you ask this question 5 years ago, people might think, wow, that's amazing. I think these days, as you know, there's a lot of white label of blockchain offering, because there are companies that provide offerings and then you white label it in your name. But the point to make it is, what is your value add in this ecosystem? What are you offering something that is different from your competitor? because I think just creating a blockchain that is that you can tokenize is one level, but I think where the value add is ability to solve a particular friction point, a problem that currently exists. Like for example, if you look at the world of payments, the cross-border payments, why does stablecoin exist? Because cross-border payments right now is expensive, it's slow, it's opaque. Obviously, the G20 is trying to solve it through improvement in the existing payment system. But right now, a lot of companies, a lot of individuals are already transacting in stable coins because it currently sort of provide a solution. Although there are arguments that you need what we call a risk-free, well-anchored mode of payment, which is why central banks like ECB are trying to convince the market that the issuance of CBDC provides what we call a viable alternative towards the privately issued cryptocurrencies. So my point here is, if we are looking at the space of the current space, there are a lot of new business models. The issue now is, play to your strength. And I think when we look at the risks, is to test the pipes, doing UAT testing before you do a global launch. If you look at last year, when the Ethereum moved from proof of work to proof of stake, it took years for them to do the testnet. And until they were satisfied, the last sort of criteria and testnet was completely done with no hiccups, then they agreed on 15th of September to pivot or move to a proof of stake. So my point here is, you need resiliency. You need to make sure that the system works, because if you want to get institutional adopted, they would insist on making sure that you have done proper testing, and that those that are providing backbone technology, they will also insist on a good report card on your SOP 1 and SOP 2 technology assessment.
Yeah, thank you, John, for this answer. And naturally, we jump into the security field also. So how does the security of digital assets compare to traditional assets, and what measures can be taken actually to protect them?
So I think where we look at the traditional security token, the tokenization aspect compared to the traditional world, I think one thing to note is, in the traditional market right now, what they're issuing is real life assets. But if you look at the tokenization capability, there are two types of assets. One is there are real life assets, which is it exists a digital twin of the real life, but it's only in a digital world. But there's also the types of assets that are what we call native assets on a blockchain. So you cannot have that alternative. If you look at the world we're in right now, right, where you have NFTs and you have digital tokens that does not exist anywhere else, and we need to create an ecosystem that you can custody, you can provide services around it, like trading, and the ability for the tokens to be delivered and move cross-border seamlessly, right, for the exchange of value. And I think we are going to move in that space, because if you look at a number of regulators, they talk about metaverse. You cannot technically have a metaverse without looking at end-to-end process. You also need to settle, the whole transaction needs to exist on-chain. Something will break if you only have one side of it on-chain, the other thing is completely off-chain. So we are going to move to the world where we probably have atomic settlement between your your securities against what we call the digital currencies. There have been a few proof of concept done by the Bank of France to do atomic settlement with CBDC against security tokens.
Okay.
Nice. On that note, I actually have a question for you, John. Yeah, like you mentioned the real world assets and tokenization. So it's actually, so what I understood, tokenization is kind of like a financialization of illiquid assets. For example, a lot of alternative investments, product, for example, wine, art, even secondary equities could be a target for tokenizations. But my question would be more on how to directly connect the real world assets to on-chain assets. How do you translate that? And within that translation, where are some of the risk compliance or issues that we should be aware of or we should work on in order to make that smooth transition?
Okay. I think the one thing that people need to understand, tokenization, it's a way of converting assets into obviously illiquid assets to be more liquid and creating fractional ownership, as I mentioned. And but one thing that people should not forget is back to basics. If what parties are offering what we call deemed regulated securities, whether you do it on-chain or off-chain, it doesn't lose its character that it has to be done through, through a regulated manner. For example, if parties are offering a security, in the past when you do ICOs, they make no distinction between, selling non-regulated tokens to respect to regulated tokens that are deemed securities. If in certain jurisdiction that these is a regulated licensable activities, parties need to make sure that they are properly licensed before they undertake such activities. It's the characterization of the token that drives a lot of this. It's not just the tokenization, because tokenization just convert certain characteristic. And I think it's important to look at substance over form. If you look at increasingly the market in crypto assets regulation, such as MiCA, even for sort of non-fungible token, it's not about the label. If what you create, you call yourself non-fungible token, but actually you're selling a securities in nature, the security regulators will frown upon it and then also will enforce against errant parties for any violation of national securities law. So my point here is tokenization does unlock certain value, but one thing you should not forget the basics. If what it is, if the activities you're undertaking is license of activities, you need to make sure that you have all the right license. Just last week, Banque de France, right, have mentioned there are, and also AMF, which is a French security regulators, they are now looking towards a new regime consistent with other national regime, is to look at the days, of whether you're providing crypto asset service is a crypto asset service, you may need to be licensed. It's not good enough to say I'm registered for AML and CFT purposes. So I think that landscape is evolving.
Nice.
And mainly it's the regulators that's going to push the evolution. You think so?
Yes, I think what has happened is the FTX incident have actually indicated that, when you create an entity with 131 subsidiaries or affiliates, and it's happened cross-border, assets are moved cross-border with crypto assets, then the question is, how do we regulate this space? Like increasingly, I think there's an acknowledgement that more needs to be done to protect consumers. And I think the only way to do it, if activities are being targeted offshore, even onshore, with respect to certain types of activities that the regulators want to be regulated, I think the bar they are setting is you need to be properly licensed.
Absolutely.
For sure.
Thank you. So it's 34, 5 minutes left. So maybe we can switch to the questions, Ethan. Do you want to the questions of the chat?
Yeah, I'll read the questions from the chat. I think the first one is from Eric. So Eric was saying, concerning the first trade made by Societe Generale recently using DAI, how do you react to the concern that they used a third party to certify the deal, which is not basically different from the traditional trade finance? All in all, tokenization and blockchain shouldn't bring transparency and security to avoid this type of third-party need if the smart contract is well set up at the initiation. So just what are your thoughts?
Yeah, I think what the SG sort of case example is doing is basically looking at using a securities token as pledging as a collateral in exchange for DAI. So one, it's innovative. Two, it also shows that when we look at DeFi space, it's not just a space between unregulated entity. So increasingly, you will probably hear the term in future called institutional DeFi. So when institutions look at certain merits or benefits of DeFi, like for example, automation of activity, and also in the context of AMM, automated market maker, you create liquidity pool that is very transparent, which is very different from traditional way of doing it. I think there are some attractive features in DeFi that through proper calibrated design could be imported in the traditional finance world with proper guardrails. And I do think all these sort of trials, proof of concept, slowly does provide the confidence to the institution that there are certain benefits one could look at rather than look at DeFi is completely decentralized, therefore I don't want to touch it. So my point here is, this is obviously, as with anything else, all it takes is just one sort of baby step to show the ecosystem that if we properly well designed, more and more institutions can play in this space with proper guardrails.
So what you say, it's bringing transparency.
That's correct.
We agree on that.
And it's real-time transparency as well. I mean, the problem with about building private permission blockchain throughout is, one, you might run the risk of providing what we call a walled garden. Everyone have their own system. So if the system doesn't talk to each other, you run the risk of interoperability concern. You can't, unless you build what we call a blockchain bridge, right? And I think when we look at the use cases, right, one should not lose sight of the fact that you can actually technically utilize a public blockchain within, and when you connect or transfer any asset, you can still provide within a private ecosystem as well. So it's what we call a hybrid. So it's not purely public. You can do a hybrid where certain activities or transactions that are recorded are public without sort of client data being put on the public blockchain, but just to show the transaction occurred. But at the same time, through a bridge or API, the private data are stored on-prem, right? So there are certain types of features that we have seen in the market that are being developed.
Nice. Should we go to the second question with Alexis? So do we have a standard token for bonds like ERC20? Because a bond token needs to be destroyed at the end of its lifetime in exchange of the capital plus interest.
Yeah, but I think if you look at the very vanilla type of bond, I think they have been doing on ERC20 or ERC1400. As you note, that transactions on a public blockchain are immutable. And what the parties do is to record that the transaction has been done and executed. It's a record. And with respect to how it's done, when parties redeem, that token is sort of burned, so to speak, quote unquote. That's the term used.
Okay, we have one last question from Samuel. Hello, John. If in 10 years we live in a fully tokenized economy, I'm wondering what does it mean to our daily lives? Is it only going to impact the financial sphere or also have a social impact?
Yeah, I think this is something that regulators are obviously very concerned about. This is a very good point. Will we live in a world that's completely what we call digitalized, and you don't have what we call the analog world or the physical world? I think if you look at least on the ECB side, they've been very, very clear, even when they issue digital euro in the future, they make it clear that cash, physical cash, will still exist. The reason is we don't want to have a situation where only parties that are technologically savvy, able to use mobile devices, can access digital cash. What about those that have no access to mobile devices or are not what we call technologically literate? So the public statement they made is cash will still be will sit alongside digital alternative. So I don't see that changing, at least in the immediate future.
Nice. Okay, so I think we're done with the Q&As, and if it's okay with everyone, I just conclude. Yeah. Okay, so John, thank you for a great discussion, and thank you all for your nice questions and contributions, and thank you, David, for hosting. I hope all of this presentation give you guys more clarity to tokenization and where the industry is heading for the next few years. And everyone who has missed our session will be able to see the replay on our YouTube side and Spotify for more podcast form. Our next event will be on digital assets with OnBlock and the blockchain lab of blockchain HEC for a one-on-one session about blockchain in general. So there will be terms, concepts, and use cases on the 26th of January. And if you have more questions, let's continue chatting on Discord. We're building a community there, and wish you have a very nice evening. I hope we see each other soon.
Thank you very much, John. It was really, really nice.
Thank you, John.
Take care. See you soon. Bye-bye.